One of the most important recurring concepts in this course is policyholder surplus or PH surplus. In order to understand that, though, you must first understand another concept called the accounting equation. Virtually all aspects of accounting and financial record keeping are based around the GAAP accounting equation, which is assets equals liabilities plus equity. This equation can also be rearranged to assets minus liabilities equals equity. In the insurance industry, we use a variation called the SAP accounting equation that essentially replaces the term equity with the term PH surplus. Now, assets includes nearly anything with financial value that a business owns. This includes financial assets such as cash and investments, physical assets such as vehicles and inventory, and receivables. Receivables refers to amounts that are owed to you. If the IRS owed you a tax refund, for example, that would show on your financial statements as an asset called income tax receivable. Insurance companies don't have very many physical assets like inventory, equipment, etc. So the large majority of their assets are in cash and investments. They can also have a significant amount of receivables too. Liabilities refers to any legally binding obligations that you have to repay money back to someone. It's easiest to think of liability as debts and promises to pay. Nearly any form of debt is considered a liability. The equity or PH surplus figure is simply the difference between your assets and your liabilities, and it reveals how much of your assets you own free and clear. To understand what this equation tells you, let's walk through how your accounting equation would develop if you were to start a new business. If you took out a $50,000 loan to start your business, you would now have $50,000 cash, but you would also have $50,000 in debt. Your accounting equation would look like this: $50,000 in cash assets minus $50,000 in liabilities equals 0 PH surplus or equity. Even though you have so much cash, it isn't really yours, and that is reflected in the PH surplus or equity figure. Now, let's say you spend some of your money to buy t-shirts to sell. All you've done is split your assets into multiple categories, cash and inventory. You haven't actually increased or decreased what you have altogether, so your equation would be updated as follows. $50,000 in assets made up of both cash and inventory minus $50,000 in liabilities still equals 0 PH surplus or equity. Next, let's say you sell all of your t-shirts and bring in $8,000 in cash sales. Your inventory is gone, but you also have more cash now. So your accounting equation would update to look like this: $53,000 in cash assets minus $50,000 in liabilities for your original loan equals $3,000 in PH surplus or equity. You can see then that anytime you gain assets without incurring more debt, your equity or PH surplus goes up. A huge aspect of this course is learning how an insurer's PH surplus balance will change if certain transactions or occurrences happen. Knowing how the three parts of the accounting equation affect each other will help you understand how and why the PH surplus number is going up or down. Now, let's explore some of the key issues that insurers face by plugging in some hypothetical numbers into a SAP accounting equation. As explained before, insurers will try to estimate how much in losses they'll pay and set that amount aside as their loss reserves. Since that amount represents a financial obligation that the insurer owes to someone else, their insureds, the loss reserves are classified as a liability. In this specific example, the insurer has $100,000 in assets, but they estimate that they will need to use $80,000 of that to cover losses, which leaves them with $20,000 in PH surplus. But an insurer's reserve amounts are merely estimates, and there is always a possibility that the actual amount will be higher or lower. If the insurer ends up having more losses than originally expected, the money to pay that difference essentially comes out of the PH surplus. As you can see then, The PH surplus essentially represents how much in spare assets you have to tap into if your reserves are ever inaccurate. In order to be financially successful then, an insurer has to hone their ability to do two things: properly estimate their reserves and always keep an adequate amount of PH surplus so they have something to tap into in case their reserve estimates were wrong. A potential problem, though, is that some assets are not as easy to sell quickly to generate cash, so they might not be able to help tide you over in times when your reserve estimates were off. How easy it is to quickly sell an asset for its stated value is referred to as the asset's liquidity, and it is a huge consideration for insurers when they do their financial planning. Let's imagine if the insurer's SAP accounting equation had looked like this, where the insurer still has $100,000 in total assets, but $20,000 of that was in office furniture. It's pretty unlikely that the insurer can quickly sell their office furniture for the full price they paid, so furniture is considered an illiquid asset. Regulators don't allow insurers to include illiquid assets when calculating their PH surplus. Assets that are liquid enough are referred to as admitted assets. So this insurer's SAP accounting equation would actually look like this: $80,000 in admitted assets minus $80,000 in liabilities equals 0 PH surplus or equity. If you only consider the insurer's admitted assets, this insurer is actually in a really dangerous position financially because they have nothing to fall back on if their loss reserve estimate is off. Again, how well an insurer manages their PH surplus is a critical factor in being successful, so this course spends a ton of time examining that. You are bound to get questions on your exam that will ask you what will happen to PH surplus if this happens or that happens. When thinking about how something will affect PH surplus, it's easiest to think of it as an emergency savings account and then remember some general rules of thumb. Anything that increases admitted assets will also increase your PH surplus because more admitted assets means you have more liquid resources to serve as a safety cushion in case you have unexpected financial obligations. Anything that increases liabilities will decrease PH surplus because having more liabilities means you are taking on more financial obligations. Since more of your money will be tied up to pay for those debts and obligations, that leaves you with less resources available for your financial safety cushion. Finally, anything that increases expenses will ultimately decrease your PH surplus because you will ultimately be spending more cash to cover those expenses, which thus strains your assets and leaves you with less financial resources to cover any financial emergencies that arise. If you ever have trouble wrapping your head around how a transaction is causing the PH surplus number to go up or down, you can always use a sample equation and play around with the numbers the way we did, and see how changing one component affects the other parts of the equation. One thing that does make it a little trickier to manage your PH surplus is how government regulations require you to record your policy acquisition costs. These costs include expenses that you incur to do your underwriting review and close a sale. Some examples of policy acquisition costs include the cost of getting a driver's abstract for someone that's applying for an auto policy, or the sales commission you pay to an agent that closed the sale. When an insurer first issues a new policy and collects the premium, that money is considered an upfront prepayment that the insurer has not technically earned yet. Therefore, at the very start of a policy, the insurer's earned income for that policy will be zero. However, the government requires insurers to immediately record all of their policy acquisition costs right away. Recording only the expenses will negatively impact your PH surplus because you have used up some of your resources to pay for those costs, leaving you with less funds available for your financial safety cushion. So, at the beginning of your policy, your PH surplus will take an immediate but temporary hit from the policy acquisition costs, but as you earn the premium income slowly over time, that income will replenish that PH surplus again. For insurers, reducing your PH surplus is undesirable, so these rules that require them to immediately recognize these expenses poses a problem. Throughout this course, you will learn how these expense recognition rules affect an insurer's business planning and what techniques they use to minimize the negative impact on their PH surplus.